Alrighty, well, let's get started. Thank you very much for joining me today, guys. My name is Elena Garrett, and this is another episode of podcast with Elena. And I am a real estate agent in Dallas-Fort Worth area of Texas, and I'm with Keller Williams Central 75, our wonderful brokerage for all your real estate needs. And today with me is Jerrett Morris. He is a loan originator at Thrive Mortgage, and we're going to be talking today about non-qualifying
Yep.
mortgage loans. Yeah, non-qualifying mortgage loans, and what that means for you when you're trying to decide whether or not you can qualify for a loan to buy a house this year or next year. So let me just say that I would love for you guys who are thinking about doing rent to own with my help, or who are trying to do seller financing, I would love for you to watch this video before you make a final decision on how to proceed with your purchase. So let's begin.
Great.
I will ask Jerrett now, can you tell us a little bit what are non-qualifying mortgages, what the non-qualifying mortgages are, and how are they different from a traditional, plain vanilla mortgage?
Yeah, great. Well, thank you so much for the opportunity to be on this video. I think it's going to be great to help your viewers learn a little more about this important information and how they can use it to become homeowners maybe faster than they thought. So thank you. So non-QM mortgages, that's what we're going to call them for the purposes of this video, because non-qualified mortgages is kind of a mouthful. So non-QM, really that's just designed to help capture the parts of the home buying market that didn't fall inside the more traditional buckets, meaning conventional, FHA, VA, things like that. And there's any number of reasons why someone might consider a non-QM mortgage. As we can see on the slide here, low credit scores, changes in employment, specifically for folks who have become self-employed. And I'm gonna come back to that one here in just a bit. Interruptions in income due to COVID. My goodness, what a year that's been, where there's people that we all know that have had gone through some stuff like that. So non-QM might be a way to help. Again, we mentioned recent new business ventures. Underreported income and business losses, a huge thing that ties back to our self-employed borrowers. And then we even can help with non-QM with evictions, bankruptcies, foreclosures, things that would have otherwise been just a total deal stopper. Non-QM can kind of come in because, again, non-QM's job within the U.S. mortgage industry is to help provide additional alternatives where people can become homeowners that maybe didn't fit in that exact box. And we also will talk a little bit about cash-based income as well.
Alrighty, so when you said that they can help, but are they still a mortgage? That's still a traditional loan? Can they buy a house with it? So tell us more about that.
Yeah, that's a great question. So absolutely, that's the whole point of these pieces of financing, is to help people become homeowners and do so in a time frame that's faster than they would have had access to if it was just, say, an FHA mortgage or a conventional mortgage or things like that, because these non-QM mortgages will give more opportunities, like we see on the screen, for some of the things that can sometimes be a problem. So at the core, it's just like a regular home loan, like a FHA or conventional loan. They can come in 30-year terms or 20 or 15, and like we would do for any client, we'll evaluate what the actual loan terms would be best for them, but it allows them to actually get a home mortgage, even in spite of some of these things that could be a challenge for another type of mortgage that somebody would be seeking.
Question to you. So apparently, and there is a task to explain whether it's like a true traditional mortgage, even though it's not traditional in some sense, is because the word non-qualifying kind of resonates with them, because very often they're told that they're not qualified.
Sure.
So there might be a little bit of a confusion before that about that. But question: so if they're applying for non-QM mortgage rather than traditional mortgage, are there any trade-offs for that? Do they have to have a huge down payment? Do they have a much higher interest rate? What are the trade-offs?
Yeah, that's a great question, and you bring up a point that I think I could help clarify as well. You know, for the purpose of this video, we'll refer to it as non-QM. But to just speak real quick to the qualifying word, where it says non-qualifying mortgages, that's really just a special designation that governmental regulators have classified these types of mortgages, because a qualified mortgage is one that really sits in the zone of like a conventional loan, FHA or VA. And a non-qualified mortgage is the other types that don't. And without taking our viewers down too far of a road, it just has to do with the rules that govern the types of mortgages, certain protections that are afforded consumers on one side or the other. So I don't want to confuse our viewers by hearing the word qualifying or qualified and thinking it relates to their specific instance. It doesn't. It's just the way the government calls it. So that's why it's easy for us to call them non-QM.
Non-QM.
And so, yeah, but when we speak of these non-QMs, there's definitely a trade-off. As any reasonable person might imagine, if they're facing a credit challenge, maybe they had an eviction, or maybe they just have been in their own business for a year or two, and they've not really got the full steam behind them. They're not, the business is going good, but it's not quite there yet. These non-QM mortgages provide a path to homeownership, but there is a trade-off, and the trade-off is almost always noted in two main areas. The interest rate is a little higher than one would expect for, say, a conventional or an FHA loan, the qualified mortgages under the government's terms. And the down payment percentages are oftentimes more than we would get than, say, with an FHA loan, which typically has one of the lowest down payment options available. So that's a trade-off. Anything in life, if there's one thing in one direction, there's sometimes a trade-off the other. Well, for non-QM, for the opportunity to be able to purchase a home, the trade-offs are, interest rates are a little higher, and certainly down payments, they may be a little more than the other types of mortgages.
Can you give me an example? Because I work a lot with people who are looking into the seller finance loans, where the interest rate is between 8 and 12%. How close would a non-qualifying mortgage come to that? Like, is it the same, lower, higher?
Yeah, that's the great news. And that's why I'm so thankful that this topic can hopefully resonate with a lot of people who are considering seller financing. Is typically most seller financing situations are going to want 20%, sometimes more. And those interest rates are just as you mentioned. But the good news is non-QM mortgages, many times we can go as low as 15%. We're even seeing some new developments where 10% down is becoming more prevalent for certain types. It's not across the board on everything, but that's a huge difference of amount of money that people can keep in their pockets rather than throwing towards the down payment. And when it comes to the interest rate, they are lower in almost every instance than what seller financing would be. So there's tremendous power there. And without really dogging too much on seller financing, because there is a place for it in some instances, but goodness, there's not a lot of consumer protection associated with seller financing. And because mortgages, even these non-QM mortgages, they're heavily regulated, by the government and other entities. There's just a higher level of protection that consumers can get. So between a better interest rate, maybe less money out of pocket, and kind of better protections for them, it's certainly a conversation worth having, so people don't just automatically assume they have to do seller financing.
Great. Now, I'm a realtor, so from a realtor standpoint, will that loan will be classified as conventional then? Because when I'm doing my paperwork and application and making an offer on a house, I have to specify what kind of a loan it is. Yeah. So, and sometimes I don't want to make an impression that we will be a difficult buyer to deal with. So how we're going to deal it in the paperwork for the...
That's a great question. And it would be technically considered conventional. So gosh, like there's so many things in life where the words that are used can be similar and confusing. And so here we are talking about qualified, not qualified, and does that relate to the client? Well, no, we're talking about the types of mortgages. But even within types of mortgages, there are conventional loans, which are typically thought of as the more kind of vanilla, boring, standard ones where people have stronger credit and some other things. But under the conventional umbrella, you could also, as it relates to how a contract is written up, these non-QM mortgages in almost any instance are going to be shown as such. So that's another benefit that, say, when you're presenting an offer, the seller won't necessarily know, other than the fact that the would-be buyer is getting conventional financing. They won't necessarily know that it's non-QM. So it helps make sure that things keep moving, and there's really not a stigma necessarily, but there's no question in the seller's mind, oh, this is a conventional loan. So I know these things can be confusing because the terms are so similar, but the non-QM within the context of how a contract's written up, it's going to be considered conventional.
That's actually is a big benefit, because as a person who already dealt with presenting offers, using seller financing, trying to understand how to write up a paperwork, explaining the protections, for example, when we're supposed to be qualified, buyer qualified. So having a traditional paperwork, which is normally goes with every contract, that doesn't look any different from any other offer that the seller would receive, really helps to move things along, because even as a person who helped buyers to buy houses with seller financing, sometimes the hardest part of our offer is explaining that our financing is indeed legit and we're not going to fall through on them.
Yep. And we talked about how non-QM will typically require a higher down payment. Well, that usually, and this as a realtor, oftentimes that's well received by a seller and their listing agents. They say, well, my
Thank
gosh,
goodness, not the VA, right? Thank goodness.
They're putting 10, 15% down, and that's viewed as a strength. And it is, for goodness sakes, for folks who are able to put 10, 15, 20% down. That means that it's showing that there's money available, there's money that's been saved up, and so it increases the confidence level. So it's kind of a 1-2 punch of, it shows it's conventional, there's a down payment there, and so it doesn't typically tend to cause any kind of panic or alarm for the most part in the seller's eyes.
Gotcha. And just for those of you who are viewing this interaction between us, you may, from a standpoint of you as a buyer or as a renter, you really don't yet understand the significance of how being a competitive in the eyes of the seller agent really helps you to secure a property, because many of you are so focused on getting a loan that you forget that securing a property with that loan is actually the bigger goal. And sometimes the way that you secure your financing can help or hurt your chances of getting into the house that you really fall in love with, because the way that your offer looks to the seller. But we're not going to go too deep into it. So now tell me, Jerrett, exactly how you can help people who are so far been looking for seller financing or rent to own.
Yeah, and the best part about this discussion is it hopefully will expand people's thought process and understanding of what's available. I've been fortunate to do what I do for going on 19 years. And so I've talked to, at this point, literally thousands of people. And through those years and along this journey, there's been a certain percentage of them that thought that their only option was to do seller financing, because they thought, well, gosh, for all the things we kind of maybe mentioned on this part of our presentation, I'm just recently a business owner. I've got these credit events in the past that I think were holding me back, or they're all the different reasons, including low credit scores. Well, this non-QM approach means that we have now greatly expanded the number of people that we have the potential to say yes to get a mortgage and start the dream of homeownership. Because, as hopefully many people know, there are many statistics out there, but being a homeowner means that you are 44 times more wealthy than a renter. So the benefit is there.
At least, in my opinion.
Yeah, it could be more than that. And so that's why non-QM is such an amazing kind of introduction into the market these past few years, to be able to help more people be told yes, that thought that their only option was to try and convince a seller to do seller financing. And again, seller financing does have a place for certain people, but there's a lot of pitfalls with it. And if our viewers realize that they have a chance, maybe more than they thought going into it, to get a regular mortgage, it's just such a powerful thing, because it puts the consumer back in control, and we're not so much at the mercy of the seller financing, which sometimes don't have really good terms, and sometimes there's some really negative stories. I heard one today, I'm not making it up, where some folks had been dutifully taking part as what they thought were buyers in a seller financing, and after 13 years, the seller just yanked the rug out from underneath them, and they have nothing at the end of it. So why go down that road if we don't have to? These non-QM mortgages can really bridge the gap on that and allow more people to get a traditional mortgage that puts them back in control.
So I will just share with you that a lot of people who come to me and ask me to help them to secure rent to own or seller financing, the number one reason is they said, I have bad credit. Now, many of them, when they say bad credit, they actually have no idea what their credit is. And I asked them, how bad is it? Do you know what your credit score is? They said, oh, no, I don't. And I said, well, how do you know that it's bad? And I said, well, I had some events in the past. I'm like, well, if you haven't checked recently, you have no idea what kind of credit you have. But let's assume that out of people who contact me, majority fall in 520, 550 category for credit for rent-to-own DV homes, and Home Partners of America require 550, 560 to qualify for their program. And a lot of people are happy with qualifying for their program. So let's just say 520, 550, 560. What can you do for them?
Yeah, so we have programs that could conceivably work with someone who has a credit score right there, and they didn't do anything to improve it. Now that's kind of an extreme, as any viewer might expect. If there was a score on the scale kind of in that range, there's going to be some trade-offs. The interest rate's going to be much higher. There's going to be a higher expectation of down payment, because every lending situation, including mortgages, is based on risk. So what is the risk of making a loan to this person or that person or this person, and the less risk that's present for the mortgage company, well, the better the loan terms. So we have some non-QM programs that can go down that far, but what we try and encourage folks to do, if they are in that range, let's do a quick assessment of what's causing that score. And we find more times than not, there may be some things that can easily be done in the very short term to kind of get it up to a higher mark. Maybe not, all the way to 620 for goodness sakes, but we can make a good jump up in the 5s or maybe just under 6. And that's going to dramatically change things. So that's what we try to encourage people to think. So non-QM can definitely help with low credit scores. But even with that, we're still going to partner with our clients to find out if there's a reasonable way in a reasonably short period of time that they might be able to take action and get it improved so that their financing improves.
Now, my question to you is, if somebody's telling me, well, I'm ready, whatever their interest rate, it probably will be comparable or lower than sort of financing. But the question is, can they refinance later? Let's just say that they take this trade-off, they do the higher interest rate right now in return for actually starting to participate in the market, starting to gain home equity, and then they can they refinance?
Yes, I'm so glad you brought that up, because that's one of the most exciting parts of a non-QM loan. It's really kind of a stepping stone. That's what we're trying to educate our clients, that if we're looking for a pathway to home ownership, okay, if there's a few challenges right now, non-QM will help open the door that otherwise was shut and allow a consumer to take the next steps to become a homeowner. They secure the home with a non-QM loan, and whatever that caused us to need to use a non-QM loan, okay, great. We're going to tackle it over the next year or two. And almost invariably, we will refinance the client out of that type of loan when their situation has improved for whatever the reasons it may have been, credit score, or maybe length of time that their new business has been open, or perhaps a previous bankruptcy or foreclosure, something like that. We will refinance, and then all of a sudden, we're now in a position where we're getting access to the regular, plain Jane, boring, vanilla, conventional, and FHA loans with the better interest rates and better terms. And to your point, the whole time, they're starting to build equity, they're having ownership. There's so many good things that come along with that. So the notion that we can refinance at the end of it is just a nice kind of prize at the end of an already better.
It's like a cherry on the top. It's a cherry on the top, right, of a cake. But the real cake is actually home equity, quite honestly, and the ownership, and not having to deal, because many people who rent and never owned before, they have no idea of what 30 years fixed mortgage is. And when I tell them that your mortgage will always stay the same, you will never have an increase in your mortgage for as long as your loan term, 15 or 20 years, it's very new to them, because most of them are they're watching their rent increase almost every year.
Yep, and that's a great point, with the exception of taxes, property taxes, which kind of move, and sometimes homeowners.
And insurance.
Yeah.
Insurance
Aside
too.
from those, to your point, the mortgage itself, especially for just a regular fixed rate mortgage, which the non-QM mortgages are, you could choose an adjustable rate mortgage, but most people choose the fixed rate. It doesn't change. And while economically we have not faced inflation for some time, at some point inflation is going to come back into the equation. It will. one of the very best hedges against inflation is a home mortgage because it's locked in, it's set. So when everything else keeps rising, the home costs kind of stay at a certain point because we've locked that mortgage in. And so that's a really cool component of being a homeowner. Is it's a wonderful hedge against inflation.
Now, just to let you know a personal story, I secured my mortgage 17 years ago, and my monthly mortgage payments were $357, and I'm very proud of it.
Yeah, that's
because it was at that time the property costs were much lower. We made a big down payment, 20%, and we secured the mortgage at that time was $512. We refinanced within 3 years. We went down to $415. We refinanced again because every time we refinanced, our amount that we were owed, we owed on a house was smaller and smaller. So our monthly payments now at $357, and I'm not sure if it's worth refinancing again. I mean, we're about to go down to zero.
Yeah, no, that's the beauty of homeownership is it provides so many different benefits, and after a certain period of time, the amount of money that you're paying towards the payment is making a much larger chunk towards principal. And I speak from experience. I don't say this to impress people, but impress upon people. I'm fortunate that I paid my house off. And that was done by refinancing my own mortgage and putting it into a 15-year and taking those extra payments. And that's a real good position to be in. It's a good feeling, and that's the benefit that homeownership can provide. And that's why it's so exciting to have this discussion about our viewers who might be considering either rent to own or seller financing. Doesn't have to go that way. There are other options, and that's why this material is so important.
Now, we talked about low credit scores. So let's just say that people who are with low credit scores, would you still encourage them? They'll say, well, my credit score is bad. It's maybe below 500. Would you still ask them to go ahead and apply with you and see what you can do?
Absolutely. And the analogy I always give is if someone suspected they had a health concern, and they went to the doctor and said, hey, doctor, I believe I've got a health concern in XYZ area, but I don't want to do any blood work. Don't do any tests. Don't ask me any questions. I just wanted to show up and tell you I think I got a bad health problem. That physician's going to have a hard time doing anything if they can't do some blood work, if she can't run some tests and things like that. So that's why it's really critical that regardless of where somebody's credit score actually is and their situation actually is, let me see it. As a practitioner, I've helped so many people through this very important journey, and we won't know what to focus on if I don't get a chance to see it. And I have clients tell me all the time, well, I'm going to do this and I'm going to do that because that'll help me. And I have to say, well, respectfully, you don't know what will or won't help you. That's my job. Let me see so I can help people be very strategic and direct their efforts, because all of us have limited amounts of time and money, and so how we direct those is really important, especially when we're pursuing something as big as homeownership. It's always better that I have the full application as soon as possible. If I'm not able to say yes right away, okay, I can build a plan so that we can make the time period from that point to when they can get the keys to a home as short as possible.
Yes, I agree. I've seen so many people who said, I'm waiting to apply for a mortgage, but right now I'm paying off my car. I'm like, why?
Nope.
But anyhow, we're not going to go there. So let's talk about people who experienced, especially with COVID, they've been laid off for some reason, either due to actually catching the virus or just their company went through downsize. And now they're at a different position. So now they had the interruption potentially with 3 or 4 or 5 months gap in income. How does the non-QM mortgages, how do they view employment, and what documentation would they require?
Yeah, so the benefit of non-QM is it's not bound by the same very kind of formulaic, tried and true guidelines that say conforming conventional loan or FHA or VA, because these non-QM loans are offered by individual banks, bank by bank. They kind of get to set their own rules. They get to decide, well, we're okay with this, we're not okay with that. So within the non-QM space, there are some that are very forgiving for employment, history, and then there's other ones where that's not really their specialty, and they're more focused on people who may have had a foreclosure or an eviction or a bankruptcy. So that's the cool thing, is that we have multiple non-QM lenders in the marketplace, And so for the folks who have gone through some employment challenges, well, first, we're always going to just see if just some of the more traditional financing might work. But in the event it doesn't, some of these non-QM lenders will allow us the opportunity to tell the story. That's the cool thing about the more traditional lending is the interest rate's usually a bit lower and the financing terms are a certain way. But non-QM, we talked about the fact that maybe more down payment, maybe higher interest rate, but we get a chance more time than not to tell the story with non-QM as opposed to just not fitting in the box. Sorry, you didn't fit the box, you got to hit the road. And so on a case-by-case basis, especially as COVID has had such a profound impact on our nation, on the globe, we at least have the opportunity to kind of paint the picture for the lender and say, hey, this is why we think this is a good bet. Here's all their history before. We had this little brief period with COVID. Boy, it was so short. And here they're already back again, moving forward. And sometimes non-QM can be the fix for that when perhaps maybe the QM world was not as ready to step into it.
Now, there is one objection that I hear quite a bit to people who say, oh, I tell them, let's go to a lender, just like you say, let's go to a doctor, right? They say, oh, my health is bad, right? My credit is bad, but I want to buy a house. And I said, well, how bad? Well, I don't know how bad it is. I just think it's bad. Yeah. And I said, well, let's go to a lender. And they said, objection number one, there will be a hard hit. And I said, well, if your credit score is bad, then this hard hit really won't change much for you in the end. But if it is, the only time the hard hit would hurt you if you did it multiple times, and you're right on the border between being approved between different, other loans. If your credit score is bad already, then whether or not we do a hard pull or not is not going to change your housing situation. Yeah. But can you address that?
Yeah, and boy, I think you said it better than I could. If the score is already in kind of rough shape, the mortgage inquiry is not going to be the thing that makes it or breaks it. It's just not. And the information that we will gain from having the full picture is worth way more than whatever couple of points we may lose on the score. So that's why I always try to encourage people, because I get that same, if you objection, I hear the objection all the time. We're like, hey, Jerrett, I'd love to talk to you, but I don't want a hard hit. And it's good that people are concerned about their credit. You need to be mindful, but there is also, to the other side, there's way too much of a fear of, oh, I don't want to be pulling my score. At the end of the day, a mortgage inquiry, from everything that we can tell, because how the credit score works is a closely guarded secret. But from what we can tell, it has about the least impact of any kind of inquiry. Because the scoring model realizes if someone's applying for a mortgage, that is not the same as applying for a credit card. And so whatever hit may actually be there is quite small. And to your point, if the credit score really is in rough shape, it is not going to affect it in a way that's going to cause us any further harm. It will do nothing but good to give us the full picture so we know what to work on and we can make a strategic, customized plan on how to get to the next step towards homeownership.
Sounds good. Speaking of the next step of the home ownership, just a little plug. We have another episode with Jerrett coming up where we're going to look at the whole path in a journey from your time when you're still a renter and still thinking about applying to the time where it's actually time to apply. We're going to give you step-by-step instructions, hopefully in a short, concise way, so you know what step to take first, second, and third. So stay tuned. Also, don't forget to hit like and subscribe if you're liking so far what you're seeing. But let's jump to our next section, recent interruptions in income. We just covered that, right? It's kind of employment and income and kind of related. So recent new business ventures. So I had quite a few people who said, I started my own company about a year and a half ago, or a year ago, or 9 months ago. So now I think I won't be able to qualify for a loan. Go.
Yeah. So this is where the non-QM space shines. I mean, it just shines. And in fact, of all the different things that non-QM can help with, this is probably the premier space, which is this country has been, and always will be built on the back of small businesses, period. And so as exciting as that is, and as awesome as that notion of, hey, we can chart our own course. You can decide to go into business for yourself, and in the United States of America, if you work hard and smart about it, then it can be successful. That is a wonderful notion. However, the mortgage guidelines don't look at it that way. The
Look at
traditional,
me. I couldn't get a mortgage because of my self-employment, 1099.
yep, exactly. So we'll talk about 1099 here in just a second, but these mortgage guidelines, they're really rigid and they say, hey, because everything is risk-based, they say, we don't know if you're going to be able to make this business work. So we want to see 2 years history on tax returns of exactly what you've done. And so that becomes an impediment because sometimes people haven't had their business for 2 years. There's also, we'll touch a little bit on this as far as underreported income. Oftentimes, if someone's a small business owner and they've made $85,000 in gross income after the accountant and the deductions happen, it may only be $39,000, and that becomes difficult for us to use for qualification purposes. So non-QM shines in this space because more times than not, we can use what's called a bank statement loan, and that is what's used in lieu of tax returns and 1099s to prove income. We say, well, what kind of deposits are coming into this bank account? We add them up, apply a formula, depending on the credit score and exactly what the person's looking for. Boom, those bank statements now become the way that we document income. And so it's a phenomenal way for self-employed folks, whether they're 1099 as a contractor or maybe a commission-only person, or they've opened a small business, which is kind of synonymous. But at the end of the day, these non-QM loans are fantastic for that, and that's why we're always excited to talk to people. And we can oftentimes help people who have been in business for as short as 6 months. A year is a little bit better, and then 2 years is even better beyond that. But non-QM really does a fantastic job in this space.
Now, talking about underreported income and business losses. So I have quite a few people who said, well, I went to the mortgage company and they qualified me for exactly $90,000 worth of home loan because my accountant and I, we're doing all we can to make all our business deductions.
Yeah.
And now, do I need to wait 2 years before, before I can qualify for a mortgage, or how did it work? So go.
Yeah, so that's kind of perfect follow-up to maybe someone who started the business, and maybe because they've got an accountant who's really good with the tax code and able to take appropriate deductions, maybe that net income is not so good. Again, this non-QM can come in and say, all right, we got you. This was your gross income after the deductions. This is the net on paper. These non-QM loans say, well, we'll look at the income a different way so we can get people approved. So because, when we look at a self-employed person, whether they're 1099 or they've opened a small company, it could be that they're new and they report a lot of income, but they don't have the time. Or it could be because they've been around for a while, but they're underreported, or maybe a mixture somewhere of all of that. And again, non-QM is great because in general, bank statements being the main way, although we have some other ways to do 1099 income, but I don't want to overcomplicate our discussion.
Okay.
The point is, we've got different ways to calculate it other than the traditional guideline that allows us to say yes to way more people who are small business owners and 1099 wage earners.
Gotcha. Okay, so wonderful. Now, along with new business ventures being sometimes a big impediment, what I encounter even more often is somebody said, well, I had an eviction last year, or I had a bankruptcy last year, possibly, and maybe even this year due to COVID or something like that. So tell me more about that.
Yeah, so again, non-QM, it saves the day in situations like this because it's not bound by the same timeline restrictions that other more traditional financing would be. So for instance, just real quick, like FHA, if someone had a certain type of bankruptcy, that might require them to be out of that bankruptcy, meaning the discharge date, for 2 years. But with non-QM, it might be that we could be 1 day out of bankruptcy. Now, with all this being said, how we operate with my team, which here at Thrive Mortgage, we're always going to run this through the lens of, does this make sense? We don't want to set somebody up for another potential financial set of troubles just by doing something so quick. But if we get the sense that, okay, we understand how the bankruptcy happened and folks are stable and everything's looking good, well then great. It might be that with some of our non-QM programs, they can be 1 day out of it. So there really is no waiting period, and we can transition because, goodness sakes, COVID, health concerns, all kinds of things like that, they're oftentimes indicators not of a person who's kind of having a financial hard time and they're a wreck. They just had maybe something really bad happen to them that was no fault of their own. And they had to claim bankruptcy, and this was the only way they could kind of set the ship right again and wanted to go forward. So this is a situation where non-QM might be a good fit.
So if somebody, let's just say, had an eviction in 2020 due to COVID, would you encourage them to still apply with you? Otherwise, their credit may be, you know, not so bad.
Yeah, exactly. It goes back to what we mentioned a few minutes ago, which is in all instances, apply with me. In all instances, let me see what we're working with, because I can provide a customized plan as to what to expect and how to go forward. And so that would be a perfect opportunity. It may not be that the mix of circumstances are right this second to be able to say yes, even with non-QM, but we'll know. And at the end of the day, that's what I'm always aiming to provide, is peace of mind. We can talk about the technical aspects of this stuff all day long, but my job, I am charged with providing financial peace of mind. So we talk to somebody who's just dealt with an eviction, we're going to look at their situation and tell them the important pieces of what they need to know. I tell my clients all the time, I get paid to tell them what they need to hear, not what they want to hear. And so if that means that we say, okay, we need to fix a couple things and then we're going to go, great. But that also it could mean, hey, you're better than you thought. We can start going right now. There's nothing that's causing you to wait.
Are foreclosures handled differently than bankruptcies?
Yep. A foreclosure is in almost any lending instance is considered like the height of a negative credit event. And the reason for this, as people might imagine if they're watching this, it hits close to home for a lender, because a foreclosure means there was a mortgage that went south and they had to take the house back. And so as a lender who was about to consider making another mortgage to a person who had a foreclosure, there's kind of a bit of a caution there to say, well, gosh, what were the circumstances that caused the foreclosure? Is it an indication of this person's not able to manage their finances and we could be having again? Or was it extraordinary events that caused the foreclosure and didn't have anything to do with the borrower's
like medical expenses? Same thing, right?
There are two family members that both had serious diseases, and there was no one could earn money. Like there was no one in the household that could earn money, and so they had no choice. They had to go into foreclosure. So that's the kind of stuff that we'll be looking at. That again, with non-QM, there is a chance for us to tell the story more so than with the QM mortgages, if that makes sense.
No, that does. Now let's go to the most difficult part, because a lot of people who are applying for seller financing are doing so because they have cash-based incomes, and very often too. Now, for non-QMs, how do you deal with Social Security? Do they need to have Social Security for non-QM?
Yeah, so within the non-QM space, we have some capabilities for what we call I-10 buyers that have just that identification number with the IRS, and they may not be in the United States under like a permanent resident alien or non-permanent resident alien. So that the non-QM space definitely encapsulates that, and so we're able to help them. Another word for that sometimes is referred to as foreign national buyers, because occasionally we have people who see the value of buying in the United States real estate market, but they live in Mexico or they live in Great Britain, or they're any number of countries, and they say, well, gosh, I've got some extra money. I'd like to buy in the safety and the security of U.S.-based real estate. So though we have those kinds of programs for sure, and that's more than we can get into for the technical aspects for this call. But if there's somebody that's watching this has got that sounds like me, another reason to reach out, and we kind of explain how that process goes. But definitely non-QM loans kind of encapsulate that as well. You'd asked about cash-based buyers, as far as cash-based income. That is a tricky one. There is pretty much no mortgage program out there, even non-QM, that would allow us to have any sort of reasonable route to the finish line to help get a person approved if we can't document the income some way. And so bank statements end up being the predominant way within non-QM that we do it. But if we have someone who the nature of their business is just intensely cash-based, where literally it's like cold, hardcore cash going back and forth, and there's maybe not much being deposited, that's probably going to be at the extreme end of what we can do. And that's also due to government rules to help prevent money laundering and some other things that have nothing to do with the person. It's just bigger picture stuff. So non-QM is going to be the best opportunity for someone in that space. But even then, that's probably going to be the most difficult of everything on that list.
Now, question to you. Let's imagine that I have somebody who is currently cash-based and they haven't filed. So I'm actually talking about the real person. I have a real person right now. His cash is intensely cash-based. He deals with cars. And I told him that because it's cash-based, you will need, and he hasn't declared his income for 2 years. He hasn't filed his tax returns. So I told him for us to go forward, we would need to file your tax returns, number one. And number two, we would need to start putting money through your actual, like, I know that you're paying rent. You're taking your money are cash and in piles, and you take out of this pile and put over this pile, but we no longer can do that. We'll have to declare, we'll now have to take them, put them into a bank account and take them out of a bank account. How long would they need to do that? For how long?
So in general, because the non-QM space continues to evolve, and we're starting to see some options that go as short as 6 months worth of bank statements. So if we have someone who has really been super cash intense, like literal cash, we're going to encourage them to get on a plan where at a minimum, they start to run that money through bank accounts, through proper deposits, for 6 months at a minimum, and then we can use those 6 months worth of bank statements to start the process to see if that would be sufficient enough to qualify them. As you might imagine, as our viewers who are seeing this might imagine, the longer period of time we have, the better the options get, and the more resources we'll have available. So I always want to make sure that we kind of highlight that as amazing as non-QM can be, it doesn't fix everything immediately. There still could be some components where we have to work with the client to tweak a few things and kind of get it in the zone. But I would say in the hypothetical example you kind of explained, and there are so many variables, so this is definitely not like a lending qualification or opinion on that, but just a gut check that it seems like a minimum of 6 months might be a good place to start. And then we would have to take the full application and make a formal credit decision on that from there. When I say credit decision, that just means as a lender, we look at the whole package and say, well, can we make this person a loan, yes or no?
Gotcha. Alrighty, well, for right now, this is all I have. So let's go back to talk about a little bit more about yourself. You have given us so much information now. How come you're so knowledgeable, and how come more lenders don't do those non-QM loans? So tell us more about Thrive Mortgage and your own, position in Thrive Mortgage.
Sure. Thrive Mortgage is my parent company, and it's a mortgage banker. So that just means that we're the ones kind of lending the money, and we've got a wide array of resources. Almost without exception, if a mortgage can be made on it, there is almost an extremely high chance that we can do it anywhere in the U.S. And we've got even some very specific special programs that no one else does that are really awesome. The non-QM space is an area where currently we serve, where we don't serve, we work on a broker basis. So that just means we have access to a lot of them. And that is great news for the viewers is there are some institutions that are kind of pigeonholed. They've only got one or two or this or that. We're always looking to expand that list. And so that's the benefit that my company provides, where I'm different than some of my colleagues in the industry. First of all, I've been doing it going on 19 years. And so
you don't look like you've been doing it for 19 years. You look like you graduated from university like 5 years ago.
Well, we'll go with that. It's unfortunately not true, but I do appreciate the compliment. But yeah, I've just been doing this for a long time. I've been around the block. I've been through the cycles. I've been in the business before the mortgage meltdown happened and all that run up, and I've lived through the Great Recession and all these things. And I've built my business exclusively on a referral basis. And so that means just one person at a time, listening to their needs, hearing what's important to them, finding out why a home matters. Maybe it's gonna be for their family or for their loved ones or who knows, but being able to do that, because at the end of the day, any mortgage person can put together, a great, set of terms and that kind of stuff. But my difference is I want to kind of partner with the client one-on-one to find out what's important to them specifically and help ensure long-term financial success. So that's the difference. I've been around the block many times, and I've helped so many people get through this process that I'm just drawing on an experience level that I'm proud to bring to bear to benefit my clients.
Gotcha. Alrighty. Well, with that said, this was Jerrett, and Jerrett has been a wonderful resource to me. And I'm sure if you stick around on my channel, you will see him quite a bit, giving us a lot of advice on how we can avoid going through, let's just say, untraditional, sometimes predatory lending that so many companies seem to provide now these days, and how can we stay in the ballpark of actually being approved to a regular mortgage without resorting to unconventional means. With that said, my name is Elena Garrett, and I'm a realtor in Dallas-Fort Worth. Now, what we're talking about, you are nationwide, right? Or can you only do Dallas-Fort Worth?
I'm licensed in the state of Texas, so these loans apply to anywhere within the great state of Texas. And
Gotcha.
I have colleagues on my team that are nationwide. So if there's someone else outside of Texas, you give me a call anyway, and I'll get you partnered up with somebody just like me.
So this is important. So if you're watching this and you're not in Texas, but you're curious about these non-QM loans, contact Jerrett and see if he will be able to hook you up with somebody who can help you in your state.
Definitely.
With that said, we're going to sign off for today. Don't forget to subscribe because we're going to have more interesting content coming up. Also with Jerrett, very shortly, I'm going to be uploading it within the next few days. So if you don't want to miss those videos, make sure to subscribe. See you later, and I will see you guys. Yeah, see you guys later.